Good evening, everybody, and welcome to this presentation brought to you by ATFX in association with Trade with Precision. My name's Chloe, and I will be with you for the next hour or so, taking you through how to design a trading strategy from start. So first of all, I'd just like to give you a couple of moments to have a look through the next couple of slides, which are the risk disclaimers. So just take a couple of moments, have a nice read through those, and make sure that you agree with everything therein before we continue with the presentation. And here is the next risk warning slide. So if you just take a couple of moments to have a look through that one, and then we will get started with the presentation. Okay, so hopefully that's enough time for you to get through those, and welcome along again. Fantastic to have you here. My name's Chloe, and what we will be going through today is we're going to have a look at the various groups and types of technical analysis that are available and discuss options on how to combine them. We're going to have a look at trading strategy concepts and the important aspects of trade and risk management and why they're considered by many experienced traders as the holy grail of technical trading. And then we're going to have a look at a real-time analysis of the current popular market price action and any potential opportunities that may be currently setting up. And also a little bit at the end about ATFX as a broker. So, the types of technical analysis. So as we can see here, there are several different types of technical analysis. We've got some concepts here. We have breakout, dead cat bounce, Dow theory, Elliott wave principle, market trend. So basically, technical analysis involved in deciding which way the market might go next. We have got chart analysis. So we've got candlestick patterns, we've got Renko, Kagi, line, open, high, low, close. People may know these as OHLC bars. And then in terms of patterns, we've got chart patterns. So things like cup and handle, double top, double bottom, flag and pennant. Lots of different types of chart patterns. We've got head and shoulders patterns, gaps, channels, triangles, triple top, triple bottom, wedge patterns. And these chart patterns are patterns that are used by various people in order to try and determine which way price might go next. They're also used in trying to determine what a suitable target might be. So generally, with chart patterns, there is a pattern that we can see on the chart, and there is a projected target once the pattern has been realized. And so that can help us not only get a directional bias for our trading, but we can also get a target for our trading. Just a quick note, I've had a note in the questions box that someone is not able to hear. So I do believe that this is a problem your end, but if anyone else could post in the questions box just to let me know that you can hear me okay and see my screen okay, that would be fantastic. Okay, everyone else can hear okay. So I think that is a problem your end. If you log off and then log back on, You should be able to hear fine. Okay, so those chart patterns, they can be used for directional bias, and they can also be used as ways of gauging where price might go next. And then in terms of patterns, we also have candlestick patterns. And those can be things like dojis, hammers, hanging man, shooting star, spinning top, morning star, 3 black crows, 3 white soldiers. Hopefully some of you may have heard of some of these names. Essentially, it's not really important what we call the candles in terms of their name. What's important is what is the background behind the candles. What is the market sentiment behind each of these different candlestick pattern shapes? And if we can analyze that, then we can use some of these patterns in our attempts to build a strategy, and again give us a directional bias and perhaps pinpoint a more specific entry. We also have support and resistance. So bottoms, Fibonacci retracements can be used as support and resistance as well, pivot points as well, horizontal support and resistance, specific prices like round numbers, prices that price tends to react against. We have got then a big bunch of indicators. Trend indicators, so we have things like CCI, Commodity Channel Index, detrended price oscillator, moving average convergence divergence, that's a very popular one. That is sometimes shortened to MACD. Moving averages, parabolic SAR. So lots of different types of trend indicators. We also have momentum indicators. So we have money flow index, relative strength index, which is shortened to RSI. That's another very popular momentum indicator. Stochastic oscillator, Williams percent range, Williams percent R. These are some very popular momentum indicators. We have got volume indicators as well, all of these things here which are used to analyze the volume in the market. Volatility indicators, so average true range, Bollinger Bands, etc. These are used to determine the volatility in the market. We have breadth indicators, so all kinds of different indicators that we can use. And in determining how to build a strategy, it's important to note that, number one, the majority of indicators are lagging indicators. So they are mathematically created based on price action that has already happened. A couple of questions here about whether there is going to be a copy of the recording, and I believe that that is the case. Yes, I believe that you will receive a copy of or a link to the recording. Any questions about that, and I'll give you a customer services email address that you can contact at the end to find out more, but I do believe that will be sent to you. So the majority of these indicators are mathematically calculated based on price action that has already happened, and therefore by their nature they are lagging. And so in terms of creating a strategy, what we want to do is, number one, we don't want to use any one indicator as the as the only thing that's getting us into or out of a trade. We want to build a strategy that uses perhaps several different indicators to use as confirmation. But first and foremost, the most important thing, I believe, is price action itself, because that is the thing that is happening on the chart. And if we can learn to read the price action and just overlay some indicators for added confidence that the direction we've picked is the correct direction, and perhaps a added confidence or an entry signal or somewhere to place our stop loss, then that can be very useful. And not relying on just one indicator. So quite often strategies use more than one indicator so that we're not relying on just one lagging indicator in order to create the strategy. And another way is learning how to read the indicators in a predictive way rather than a lagging way, and that can be done with some of these indicators. So an example of, for example, Williams percent R and stochastic. Williams percent R and stochastic work in a very similar way. These are momentum indicators, and they compare the closing price to a range of the instrument's prices over a period of time. And therefore, they can give us an indication of overbought and oversold conditions. So when a market is overbought and or oversold, meaning if a market has been going up for a considerable amount of time, it may get into overbought territory and be due a correction back to the downside, and vice versa, or oversold, it may be due a correction back to the upside. And the reason these indicators use these calculations of comparing closing price to a range of prices is that in a trend, it is said that the bar is going to close near the high or the low of a bar. So in an uptrend, the closer the bar closes to the high, the stronger the trend is, and vice versa. So that is one way that these indicators can be very useful. So it's useful to combine both trend and momentum indicators. Trend to determine the trend, and momentum to determine the strength of that trend and the likelihood of whether that trend is going to continue or retrace. The leading indicators I consider to be the price action. So charts, this stuff at the top here, this is the price action on the chart. So this is what is happening currently with price. So if we see, for example, a morning star candlestick pattern, that is price on a chart, that is pure price action, and that is what is happening now. And we can read the sentiment behind the market by analyzing these candlestick patterns without any mathematical calculations, without anything that's based on previous price action. That is just what's happening now. So I think it's very important to use that in a strategy and then just overlay indicators on top of that. So it is a little bit beyond the scope of an hour presentation to go through every single one of these indicators in detail. So what I'm going to do is I'm going to have a look at the platform have a look at a few of these indicators and then start to build up a picture of how to design a trading strategy from start. So I'm going to get the platform up now. Bear with me. Okay, so we have here the ATFX MT4 platform. And so this is what I'm going to use to base my discussion on creating a strategy. You'll notice here that I just have a blank chart here. So first of all, the discussion is, do we use the two most popular forms of the chart? Well, I suppose there are three forms actually. We have got the OHLC, or open, low, high, close, open, high, low, close bars. And that is what we can see just here. Hopefully the colors are clear enough for you there. So I generally tend to color my downwards bars, my bearish bars in red and my bullish bars in green. And let me just change that a little bit so that it is a little bit darker. Okay. So the OHLC bars give us an indication of direction. They show us where the open and the close and also the high and low of each period of time there. So this is a daily time frame that I have up here. Each one of these bars represents a day, and I've got an indication of where the open is, where the close is, and where the low and high are. So that is very useful information to have. Candlesticks shows us exactly the same information, but it just fills in the body of the candle, we call it, in the color of that candle. So we still see the open price, the close price down at the bottom here, the high and the low, which are represented by the wicks of the candle. And I personally find that using candlesticks is my favorite way of analyzing price action, because it gives me a very, I can see very clearly, which way price is going for each period of time. Do we have a green candle or a red candle? And I can also see very clearly how big the body of the candle is relative to the wicks of the candle, and that gives me an indication of what's going on in the market. So just to find an example perhaps of a candlestick pattern that can be used. So we have what some people may refer to as a shooting star here. Essentially that is a candle in which the buyers moved strongly up to the top of the candle, and then the sellers came in and pushed price all the way back down, and price closed near where it opened. It doesn't matter so much what color the candle is. What's important is how long this wick is, and the fact that the wick is several times larger than the body of the candle. So that indicates a potential change in direction. And you can see here we often find these at the top of a cycle of price. So price has moved up here, it's changed direction here, and then it's resulted in a move down. So this is one thing that I very often use in my strategy creation, is these specific types of bars. We can also see another one here. Another one here. And another one here. Mouse not working very well today. Apologies for that. So that's an example of a candlestick pattern. Okay, so some of you are not familiar with candlestick patterns. It's going to be very difficult to get to the end of the session today and explain absolutely everything about all the concepts that I'm going to go through. I could honestly talk for probably 2 hours about candlestick patterns. It's one of my favorite things to talk about, in fact. So I will try and give as much detail as I can, but I do also have quite a lot of content that I need to get through. So essentially, with this candlestick pattern here that I'm looking at, all that I'm looking at in the market is, are the buyers winning the battle or are the sellers winning the battle? Because essentially my options are, am I going to buy this market or am I going to sell this market? And what can I use in order to help me make those decisions? And there are various different candlestick patterns that we can use to give us a directional bias. And this is one of them here. Essentially, what's happened here is prices opened. This is a daily chart. So each one of these candlesticks represents the trading that has happened over the course of a day. And so on this day, prices opened at a certain level. Again, apologies for my drawing here. That looks a bit better. Okay. Prices opened here. The buyers have pushed price up. The sellers have taken control again and pushed price down. And prices closed here down near where it opened. So that's what this candlestick is telling us. So essentially what that means is that buyers have attempted to push the price up. They have failed to take it higher than here, and the sellers have taken control of the market. And the sellers are the ones that have been in control of the market the last. And so if price then continues down from here on the next bar, the next day, that is a very bearish sign, and it's a sign that the market could potentially move further downwards. And that is indeed what's happened here. The buyers have come up, the sellers have pushed price down, and then the market has continued in the downwards direction. So it is possible to use these candlestick patterns to give us an indication of direction. Now, one thing that I like to do is use these candlestick patterns on a higher time frame to give me an indication of direction, and then go to a lower time frame to try and find a way into the market according to the direction that I have decided on. Now, another thing that we can use to give us direction is chart patterns. And you heard me mention several different chart patterns. I'm just going to see if I can find a good example of one. Oops. That I can use to demonstrate a change in direction. There is one here, it's not the best. Let me see if I can find a better one. This might be a little bit better. Now I'm going to look at a head and shoulders pattern. Head and shoulders pattern, we have a left-hand shoulder, we have a head at the top, and we have a right-hand shoulder. And the neckline between the the low formed by the left-hand shoulder and the low formed by the right-hand shoulder. If we join those up, we get the neckline. A break of the neckline tends to mean a bearish move to the downside. So that's not a perfect example there, but it just does give you an indication. And again, you can see how that actually, all we're doing is analyzing the price action on the chart and working out who is in charge of the market. It's the same as a double top or a double bottom is the opposite at the bottom. All we're saying is that price has come up. It's made a high up here, and then the buyers have attempted back up, but they've failed to get back. They've failed to get back up to this high, and they've actually only managed to make a lower high here. So that means that the buyers have attempted to push price higher, but they've failed, and the sellers have come into the market instead, and they push price lower. So we're just analyzing who is in charge of the market, the buyers or sellers, and we can get a directional bias from that. So that is some very, very basic brief price action analysis that we can use in our trading. Now, another thing that I like to use is trend analysis. Now, we can use some very simple things, for example, moving averages for trend analysis. So I'm just going to pop a 50 moving average onto the chart. We can see very simply from this 50 moving average that it's pointing upwards. It's pointing in the upwards direction. The moving average is heading higher, and that tends to suggest that price is heading higher and the trend is therefore up. Now, if we use more than one moving average, that gives us added confidence that that trend is moving up. And I'll just put a 20 moving average on there. So having a 20 moving average as well, not only can we see that the direction of the trend is up, but we can also see that the faster moving average, the 20 moving average, is above the 50 moving average. And that gives us another indication that the trend is up. When we have a faster moving average above a slower moving average, and both of them are pointing upwards, that suggests that the trend is up. So a moving average is an average of price over the last period of time. So for example, a 20 moving average, and remembering that we're on a daily time frame here, the 20 moving average on the daily time frame is going to be the average price of the last 20 bars, and that's calculated. So the 50 moving average is going to be the average price of the last 50 bars, the last 50 days. And these will recalculate when we change time frames. So for example, if I now change down to an hourly chart, I still have my 20 moving average and 50 moving average here, and those are now calculated based on the last 20 hours or the last 50 hours. So the moving averages are simply ways to smooth out price so that we can get an overall idea of what direction the market is going in. They can give us an idea of direction both by the direction they're pointing in and whether the faster one is above or below the slower one. And they can also, as you can see here, give us areas that might be sensible places to trade, because they are also used as levels of dynamic support and resistance. So we can see quite often that price will react against these levels. And so that's another thing that we can build into our strategy in order to give us a good place to trade. And so can you see here that if we use our very simple analysis of price action and trend, if we use our very simple analysis of price, action, and trend to decide on a direction. So my direction up here is up because price action is going up. My trend analysis is telling me I have higher lows here and higher highs. And I also have my moving averages pointing up, and I have my faster moving average above my slower moving average. And now if I use my knowledge of candlestick patterns and perhaps use these candlestick patterns where I have long tails, where I've got a rejection of the what we call the retracement. The trend is up, so the strong move is in the upwards direction, but then we have the market kind of breathing in and coming back down. Then we see this candlestick pattern here, which is a rejection of this level in association with the moving average here. We can start to see, and also here, these aren't perfect, these ones here, but we can see that we do have these kind of small body, long tail candlesticks here. So we can start to put this together into building a trading strategy. Now, I want to bring a few more things into the equation here. So I'm going to bring a couple of indicators. Another thing that we can look at is horizontal levels, because we can trade breakouts from ranges where we get horizontal levels. So, for example, drawing levels of support and resistance, we can see here that price is struggling to get through this level here, and we could have a strategy whereby if price does manage to get through this level, we could decide to buy. So if we can analyze price in terms of horizontal levels of support and resistance, so let me just draw a few more levels here. Can you see how price has reacted here against this level? So that is resistance. Price has reacted again here and here. And then price has eventually broken through that level, and the level is now acting as support down here. So we can build that into our strategy creation as well. Let me find another couple of examples. We can use this level here, for example, which is one that I already placed on, but we can see how that level is being respected as resistance. So each time price is hitting that level, it's coming back down, hitting the level, coming back down, hitting the level up here, and coming back down. This is one that doesn't actually come back down very far. And if we overlay our knowledge of candlestick direction as well, then that could help us to build a trading strategy. Now, what is a trading strategy? I think it's very important to go through that actually. So a trading strategy is something that gives us an exact place to enter a trade, an exact place to exit a trade, whether that be for profit or for a loss. So with any trading strategy, we need to know where to enter our trade. We need to know where our target for the trade is going to be. And we also need to know where are we going to get out of the trade if the trade doesn't go in our direction. That's essential to know, because without that information, then we can have no idea of what risk we are placing on the trade. So we need to know the price at which we're going to enter, the price at which we're going to place our stop loss, which means where we're going to come out of the trade if the trade goes against us. Once we know those two things, then we can measure our risk, and we can place the size of trade based on that distance between our entry and stop loss. We can then decide what size of trade to place in order to keep our risk at a standard set amount. So a lot of traders, a lot of professional traders, trade using a maximum risk of just 1% of their available account. A lot of traders who trade very large accounts will trade at even less than that, 0.5% or 0.25% even risk. And so if we know where we're going to be entering, let me just go back to current price. If, for example, we were seeing this as a level of resistance up here, so price is currently below this level. There's our level of resistance. And perhaps we want to buy when price breaks above this level of resistance with a stop loss, a sensible place for the stop loss. The safest place would be at the lows here. But we could also have a stop loss at the lows here, because this is another place where prices come down, and then we're anticipating price moving up from here. So let's assume that we're going to buy at this level here, and our stop loss is going to be at this level here, and our target is going to be at this level here. And so what we need to do is measure the number of pips in between our entry level and our stop loss level. Let's call it 100 pips. And then we need to work out our position size based on 100 pips being 1%, for example, of our account. So if we have an account with, say, $1,000 or £1,000 in, 1% of that would be £10 or $10, and therefore I want to position size so that over this 100 pips that I have between my entry and my stop loss, if price were to come down and hit my stop loss, I would only lose £10 or $10. So hopefully that makes sense to everyone. We need to know where our stop loss is going to be so that we can position size our trade, so that we know that if we lose this trade, we're only losing a set fixed amount of our account, which could be 1% or $10 of our account. And if we make money on this trade and it goes up here, we've got approximately double the distance. So if price goes in our favor and gets to our target, for the 1% risk, for the 100 pips we've risked, we make 200 pips, and that will relate to 2%. So we make double what we've risked. That's very important in a strategy to understand the reward to risk, because all strategies have a probability of success, and all strategies must have a reward to risk ratio as well. So our probability of success, if we have a 60% probability of success and a 2-to-1 reward to risk ratio, then overall we're going to be profitable. If we have a 50% probability of success and a 2-to-1 reward to risk ratio, also we're going to be profitable. And in fact, we could only have a 40% probability of success with a 2-to-1 reward to risk ratio and still be profitable over a period of time. So it's very, very important to have a set strategy where you know the probability of success and you know the reward to risk, because then you can trade confidently. You don't need to worry about the losing trades so much, because you know that over a period of time that strategy has been proven successful to a certain percentage, and if your reward to risk ratio is correct as well, then over that period of time you will be profitable. So very, very important is knowing where to get in, knowing where to get out for a loss, and knowing where to get out for a profit. And that is very, very important. That is basically all we're talking about here when we're talking about building a strategy, is where to get in and where to get out. After that point, we can also think about trade management. And if we're thinking about trade management, what I mean by that is perhaps a stop loss management. So, for example, if we see this as a level of resistance here, and we wanted to get into the trade when that level of resistance was broken, with perhaps a stop loss under the recent low here, then perhaps our trade management would be every time price makes another low, we could trail our stop loss. And that way we're locking in profits. So not only are we making money as price goes up, but we're also locking in profits, because that means if our stop loss is now up here, price can't come all the way back down here and we're giving all of our money back to the market. If price just comes down here, then we get stopped out of the trade, and actually that would still be a profitable trade. Even though we're stopped out, it would still overall be a profitable trade because we've moved our stop loss up. And again, here we could potentially move our stop loss up again. So overall, we've had a really nice profitable trade with a high reward to risk potential just by trailing our stop loss up each time. So I'm going to have a look at putting a few more indicators on the chart. And what I'm going to do, good question, do we move our stop loss manually, or can this be automated? It can be automated if you are familiar with MT4 and EAs, expert advisors. You can pretty much program or get someone to program this for you so that you can have an automated trailing stop loss. But what I find, especially when we're trading on the daily time frame, it's very easy just to check back on the charts every day, and simply all we need to do is drag our stop loss up to the place that we want it. And we can do that over a period of several days, or if we're trading on an hourly time frame, for example, we can do that if we check back on our charts every few hours, or even every hour. We can do that. So I'm going to add an RSI. So just for the purposes of this, I'm just going to keep the standard settings for RSI. Generally, the standard settings tend to be a 14 period. So RSI, this is an indicator that can be used to indicate overbought and oversold. So it's generally said that if it goes above the 70% level, it's overbought, and below the 30 level is oversold. So can you see how, for example, in this downtrend here, the RSI goes into oversold territory down here, It also indicates a potential end to this downtrend. So if we were selling, for example, with our candlestick pattern here and our moving average, we might have decided to sell at that point there. And if we were selling at that point there, we might be looking for something in our indicator to tell us to get out of this trade for profit. And so we could use that. Now, it's always a good idea, I think, to look back over a period of time and note the real extreme levels on these indicators. So you can see here a little bit more clearly extreme levels when the indicator is going from the bottom to the top and from the top to the bottom. Stuff like this here, where it's just kind of gradually moving down to the bottom, that can tend to happen when we have trend, and therefore not necessarily mean that as soon as it gets to the bottom it's overextended. We want to be a little bit careful about that, but certainly I'm going to just draw in some other places where we see price get into overbought territory. So can you see how when the indicator gets into overbought territory, we do sometimes see that price comes back again. So it's moving upwards, it gets into overbought territory, and then it moves back downwards. Over here as well, we've got a strong move to the upside. The indicator goes into overbought territory and then it moves back downwards. So that's one way that we can use the indicator. Now, as I mentioned earlier, these indicators are based on price action that's already happened. So they're not predictive when read in this way. The price action's already happened, and then the indicator follows the price action. And so with that being the case, if we can find a way to use these as predictive rather than historical indicators, that can be very helpful. So one way that we can do this is by looking at indicator convergence and divergence. So for example, when price is making a new high, the indicator is not making a new high, and that might be an indication, bearing in mind that this is a momentum indicator, RSI, so therefore it's an indication that the momentum in this long move to the upside could be coming to an end. This trend is no longer as healthy as it once was, and we may then see a correction. And so that can be used not only as a way of filtering out bad trades, but also as a way of taking profit on trades that we're already in, especially if we see something like this kind of price action here, which we've discussed, our candlestick price action here that suggests a move to the downside, and indicator divergence here. It may be time to start thinking about, especially when we see this lower high as well, maybe time to start thinking about coming out of this trade. So I think it's quite important to have various different indicators on within our strategy. First of all, we need to know about price action. Is price moving up or is it moving down? And then what are we going to use in order to get into price? Are we going to use horizontal levels? So for example, this horizontal level here, which has been support, it has been resistance here, it's been support again here. So quite possibly it would be an area that we would be looking at here. It broke through here, but on this occasion it's acted as support. So bringing in levels of support and resistance can be extremely profitable for trading. Are we going to use trend indicators such as moving averages to build a clearer picture of whether the market is trending or ranging? And price action in terms of candlestick patterns or price chart patterns, that can help give us an indication of direction. Are we going to be trading a breakout, or are we going to be trading a kind of trend following system? So a breakout would be something like this, where we have a horizontal level here and we're waiting for price to break out from that level. Or a trend following system would be something like this, where we have a higher high and we're looking for a higher low in order to get into the market there. And we're looking at successive cycles of higher lows and higher highs. And then it's a case of overlaying our indicators. So I've just shown you one indicator here, which is the RSI. We can also have a look at MACD, which is a trending indicator. Again, I'm just going to leave all of the standard conditions here, the standard settings, 12, 26, and 9 for MACD. I'm just going to leave those as they are, just so that we can have a look at this. And there's various different ways of reading MACD. Some people read the crossover between the signal line and the MACD line. And again, some people read the convergence and or divergence of these. So again, suggesting this is pointing downwards, as is the RSI, where price is pointing upwards. So that suggests that the momentum and the trend is no longer as healthy as it once was, and perhaps that could be coming to an end. So we may want to avoid entering another trade around here, because of the fact that now the RSI and the MACD are both pointing downwards. So that suggests that this trend is no longer healthy, and perhaps we could be about to start a further move to the downside. So that can help us with our strategy as well. And then we can also have things like Bollinger Bands. Again, just for the purposes of this, I'm going to leave the standard settings there just to show you. And you can see here that Bollinger Bands, they can be used in various different ways. They can be used to determine trend versus range. When the bands are, I'm just going to erase off a few of these things here just to make it a little bit cleaner. When the bands are close together, like they are here, that can tend to mean that price is ranging. And you can see actually here that price is actually ranging in that point. And then when the bands start moving further apart, that can tend to mean that that is the potential beginning of a trend, which we then do see here. So that's one way that Bollinger Bands can be used. And another way is also for entries and targets. So for example, if we were to enter this trade here that we've been discussing, this hypothetical trade, then perhaps when price hits the Bollinger Band, we might want to think about scaling it out. But we want to be careful about that as well, because in an uptrend, price can tend to hit the band and then stay up there and continue to move upwards. So another way of using these, if we have determined that we're in an uptrend, then we can use these as ways of entry. For example, when price comes down to the bottom that may be an opportunity to buy. Or when price comes back down to the middle, also potentially an opportunity to buy. So I'm not actually giving you a strategy here, but I'm giving you some food for thought in terms of what you might like to start thinking about using in order to create a strategy. But the most important thing is that with a strategy we have a specific place to enter, a specific target in mind, and a specific place that our stop loss will be in case the trade goes against us. Those are the most important things, and we want our indicators to support that and to give us those places to buy and to sell and to take profit or take a loss. So I just want to go back to the presentation quickly. And just to finish off, a little bit about ATFX and why choose ATFX. So ATFX, they are the winner of the Online Personal Wealth Awards 2018. That's a very nice recent award there. They're regulated by the Financial Conduct Authority, the FCA. They have an efficient, secure, easy-to-use payment portal. They're committed to providing competitive prices for their clients. They use MT4, which is global investors' most widely used trading platform. Now, we've gone through a little bit of what's available on MT4. Really, we've only scratched the surface. There are a lot of indicators in MT4 that we can use and a lot of functionality. Very, very easy to use platform once you get used to it. So it's fantastic that ATFX offer that. And they have a bespoke customer service and trade support team for all client trading needs 24/5. So the contact details that you may need there's the postal address there. There are phone numbers that you can call to speak to customer service. There's a number within the UK and a number from anywhere outside the UK as well. And those hours are Monday to Friday, 9 AM to 5 PM. And account and sales inquiries, there's an email address there, sales.uk@atfx.com, and then also a customer support email address as well. So any questions that you have about opening an account or any other questions that you might have, cs.uk@atfx.com. So those are the details that you need. So thank you very much for being with me for this hour. I hope you've got some benefit out of the presentation. Obviously, an hour is a very short amount of time to talk about all of the things needed for creating a strategy, but hopefully it's given you some food for thought at least. And I do hope to speak to you again at another one of these presentations. So thanks, guys. Have a wonderful evening.